I'm Corrina Humphries. I work for GBAC and we're accountancy and business advisors. Okay, so I'm going to talk about how the new finance cost restrictions work for tax. We had a question that said, could we illustrate how Section 24 will affect my property income and what would be suitable? What would be a suitable and a legal way of mitigating any increase in tax?
So Section 24 is basically the new way that the taxman will take more money out of the landlord's pocket due to the way the mortgage costs are sorted.
Exactly,
in layman's terms.
That's correct, yes. So the new finance cost restrictions, for ease I'll call it interest cost restrictions because it's mainly interest costs on mortgages that we're talking about. They came in from 6th of April 2017. And they relate to finance costs in relation to residential property. And what's happening now is that rather than get tax relief at your marginal rate of tax, so say if you pay a 40 or 45% tax, you will only get tax relief at 20%. It doesn't apply to companies and it doesn't apply to commercial property or furnished holiday lettings.
I've got a question coming on that one later, so...
Right, okay. Okay, and the restriction is going to be phased in over 4 years. This table just shows how it's been phased in. So currently, in the year that maybe everybody's just completed a tax return for or just about to submit them, what happens is you get 100% of your interest costs allowed against your property income. So when you're calculating how much your taxable profit is, you allow 100% of the interest. What's happening from 2017, 2018, so in this current year, is 75% of your property interest you'll get allowed in the same way, where you get 100% relief, but 25% of it, you will only get relief at the basic rate of income tax, which is 20%. So if you are a 40 or a 45% taxpayer, you're only going to get relief at 20%. And then gradually, each year, that's going to increase until we get to 2021, where all of your interest costs, you will only get relief for the basic rate of income tax. I've got an example to show you how that works. So in this example, we've got John, who's a higher rate taxpayer earning £60,000 per annum. He has just a single residential property that generates £6,000 per year after paying mortgage interest of £4,000. So currently, that £4,000 saves him tax relief at 40%. So if we assume that the current tax rates apply throughout the years of the example and that the allowances are the same, it's just a bit easier to explain the numbers. Okay. So, in the first column, 2016-17 are the current rules. So what we can see there is that someone with earnings of £60,000 and net rents after 4,000 interest of 6,000, so £66,000 worth of taxable income, their tax liability is 15,600. When we move on to 2017-18, when the restriction starts to apply, that £4,000 worth of loan interest, £1,000 of that needs adding back, so a quarter of it, 25% of it needs adding back to the income, and now we can see that the taxable income, instead of being 66,000, is 67,000. You then calculate the tax in the usual way, and then that interest where we've not allowed tax relief, the £1,000, you get tax relief at the basic rate of income tax, i.e. 20%. So what that means in that first year, 2017-2018, John's paying an extra £200 in income tax. And what you can see as the numbers move across is by the time we get to 2021, he's still got his £60,000 worth of earnings. He's got his £6,000 net rent after interest. We have to add back all that interest, and that means his taxable income now, instead of being 66,000 as it is in the current rules, becomes £70,000. That means that his tax liability increases to 17,200, just in the last column there. He then gets tax relief on the £4,000 worth of interest, but only at 20%, no longer at 40%. So ultimately he's paying extra tax over the period of £800 a year now, which is the £4,000 at 20%. Okay, so that's just a simple example, just to show you how it works. The other thing that you have to bear in mind is it's not just that you will pay extra tax because you no longer get tax relief at your marginal income tax rate. It can also affect other benefits. It can affect your personal allowance, because what happens is you use the taxable income threshold in order to see, for example, if you receive child benefit. You can receive child benefit as long as the highest earner in the house doesn't earn more than £50,000. Now, these new rules could change your income for that purpose. The other point to consider is personal allowance. Everybody receives a tax-free amount, currently £11,500. But if your income goes above £100,000, that personal allowance reduces. These rules could make your income go above £100,000, even though you've still got exactly the same amount of income, your taxable income increases. So I've just got another example to demonstrate that. So this is Janet. Janet has a portfolio of buy-to-let residential properties. These generate £45,000 worth of rental income after mortgage interest of £30,000. Her husband earns £45,000 a year and they have 3 young children. So currently neither of them earns more than £50,000. So they currently get child benefit for 3 children. Again, I'm assuming that the tax rates and allowances remain the same. Okay, so again, working through the figures as before. So Janet has £45,000 worth of net rents in the 2016-17 tax year. Her tax liability on that is £7,200. When we get to 2017-2018, that £30,000 worth of interest, a quarter of that needs to be added back when calculating what her taxable income is. So you can see that her taxable income increases to £52,500, and that's gone above the £50,000 limit for child benefit. So working down the column, you can see that the increase in tax for that year is £2,125, and that's made up of 2 things. It's made up of extra tax because she's no longer getting 40% tax relief on £7,500 worth of the interest, plus a clawback of a child benefit of £625. You can then see how, as the interest relief restrictions phased in, how that changes things. And the following year, 2018-19, now we have to add back a half of her interest before we work out how much her taxable income is. That increases her taxable income to £60,000. So not only does that mean that on £15,000 worth of interest, she's now only getting tax relief at 20%, so that's costing her an extra £3,000. She's also got to repay back all of her child benefit of £2,500. Okay, so it becomes, she's receiving exactly the same amount of net income, but she's paying back her child benefit and paying a lot extra tax. And you can see when the rules are fully in, she still pays back all of her child benefit, but the £30,000 interest, now all of it only saves her tax at 20%, costing her an extra £6,000 on the interest restriction. Okay. So, as you can see, it can be quite a substantial amount that people have to pay because of it. So what can you do about it? There's no easy answer to that, and there's no one-size-fits-all. We have a few solutions, but it does depend on your personal circumstances as to whether they will actually work for you. One solution you've probably heard mentioned a lot is it worth incorporating? Is it worth moving your property portfolio from personal ownership into a limited company? In certain circumstances, the answer is yes, but you can create quite large tax liabilities if you do that. You've got to consider stamp duty land tax, because moving from individual ownership into a company creates a stamp duty land tax charge in certain circumstances because you're deemed to sell those properties for their market value. And as you know, stamp duty land tax has gone up, and for residential properties you have the extra 3% surcharge as well. But there are some reliefs that can be claimed. If anybody operates a business through a partnership, for example, there is a relief that potentially can be claimed to reduce that stamp duty land tax to nil. The other major tax on moving property into a limited companies is capital gains tax. Again, there is a relief that can be claimed in certain circumstances, depending on whether your property rental business is a full-time occupation, really, is you know, you're involved in a lot of hours in managing the properties. The other thing to consider about moving into a limited company is, will the banks allow you to do that? Because you would need to get them on side, and the mortgage broker and the mortgage companies, in order to enable you to move the loans into the limited company, because you have to assign them across in order to get the best benefit. If they will do it, will they charge you extra fees? So it all needs looking at to see whether or not it is worth doing. If a limited company is not a good solution, maybe simply looking how the properties are owned. Is it worth transferring some of the properties into joint ownership with your spouse, if they pay a lower rate of income tax? Is it worth considering bringing family members into the business? Again, there might be tax charges, so you need to look at the numbers. Also, focusing on the costs. Is there any costs that you can reduce? Look at the mortgage interest that you do pay. Could you get a better deal? Is it worth maybe looking at your own property and raising money on your own property at a lower rate and repaying the buy-to-let mortgage? They're all ideas, you know, that might work for you. It might be that you have to pass on some extra cost to tenants. Okay.
Interestingly, I work with about 136 letting agents all around the UK, and the same question keeps coming up. There's a few comments which I'd like to throw in as a journalist in terms of things that you can do to mitigate this. The first one is a lot of landlords are quite lazy, and I say that with the utmost respect, lazy when it comes to their rent increases for tenants that have been there a long time. Oh, Floss, she's been with us 4 years. I don't want to affect her or drive her out. And again, as an agent, we can actually go and have a look at what's happening to rents. And it amazes me when you look at an apartment block. And I've done one in Sheffield recently where you're looking at the same property and there is genuinely £100 a month difference for the same apartment. And whether that's lazy agent, lazy landlord, or just sitting tenants, I don't know. But, you know, you're in business, guys. You know, if it's too much, they'll soon leave. The second one is, when the tenant does hand their notice in, it's a golden opportunity to enable you to just take one step back. The agent doesn't have to put it straight back on the market straight away. There's an opportunity to go in with your proverbial feather duster, liquor paint, new carpets. And again, what we said about the more Waitrose sort of tenants is that it's a golden opportunity, because remember, if memory serves well, if you actually spend money on a property, you can get it back. I know you were losing the 10%, which will come on, that's a question later. But spend some money on it to move it from a Tesco's property to a Waitrose property. Just a thought. And again, let's leave you at this one. Rents have risen by 10.5% since 2008. Inflation has been 38%. Think about it.